What if I told you that one single announcement from the Federal Reserve just reshaped the future of your mortgage and possibly your entire financial strategy? It's not just speculation or media hype. This is a real dramatic shift that will impact homeowners, buyers, investors, and even renters for years to come. The Fed's latest move wasn't just a small tweak to interest rates, it was a signal, loud and clear, that the era of predictable mortgage behavior is over. For anyone who has been watching the market closely, the signs were there. Inflation slowing but not gone, recession threats fading but not forgotten, and housing demand still climbing in many regions. But nobody expected the Fed to act this decisively. Now, mortgage rates, both fixed and variable, are entering a new chapter. And the rules of the game? They've changed. When I first heard the announcement, I immediately thought of my own home loan. Like millions of others, I locked in a relatively low fixed rate during the pandemic-era dip. But this new development had me thinking, is it time to refinance, sell, or switch to a more flexible loan product? That question isn't just for homeowners like me. It affects every person trying to buy a home, invest in real estate, or simply plan for their financial future. Let's break down exactly what the Fed announced, why it's a bombshell, and what it means for mortgage rates starting now. First, the central bank hinted that rate cuts might not come at all this year, even if inflation cools further. This is huge. Why? Because for decades, we've gotten used to the idea that when inflation goes down, interest rates follow. That pattern has given buyers confidence and helped fuel real estate cycles. But this time, the Fed signaled something very different. Instead of reacting only to inflation, they're now factoring in long-term structural shifts, like demographic trends, wage inflation, and global debt cycles. This means interest rates might stay higher for longer, regardless of what inflation does in the short term. If you're wondering what this has to do with your mortgage, the answer is everything. A higher base interest rate from the Fed directly influences the cost of borrowing. Banks adjust their lending rates based on it. That means mortgages, especially adjustable ones, are going to reflect this new reality almost instantly. Even fixed-rate products will become more expensive as long-term bond yields adjust upward in response to the Fed's stance. So what should you do if you're planning to buy a home soon? Or if you're locked into a high mortgage and wondering if it's worth refinancing? You need a strategy that goes beyond just comparing rates. It's about understanding your timing, your financial flexibility, and your risk tolerance. In the next few minutes, I'll walk you through how to evaluate your mortgage strategy based on this new Fed position. Whether you're a first-time buyer, a long-term investor, or somewhere in between, there are smart moves you can make right now to stay ahead of the curve. We'll also talk about new lending models, alternative mortgage products, and creative strategies that can help you keep costs low even in a high-rate environment. Let's dive into the practical implications of this new era and how you can turn uncertainty into opportunity. First, if you're considering buying a home in the next 6 to 12 months, the biggest mistake you can make is waiting for rates to drop. Many potential buyers are sitting on the sidelines, hoping for the return of the ultra-low rates we saw during the pandemic. But here's the truth. That window is gone. The Fed has made it clear that even if inflation cools, they are no longer reacting with immediate rate cuts. Instead, they are adopting a higher-for-longer mindset, focusing on long-term stability rather than short-term relief. That means waiting might not only delay your goals, but also expose you to rising home prices, which are still climbing in many markets due to inventory shortages. If you find a home that fits your needs and budget, locking in a rate now, while adjusting expectations, can be smarter than waiting endlessly for a perfect scenario. Many banks are even offering refinance later with no penalty programs, allowing buyers to act now and adjust when the market shifts again. For those with existing mortgages, especially adjustable rate ones, now is the time to review the fine print. When will your rate reset? How much could it increase under the new Fed outlook? You might want to consider refinancing into a fixed-rate mortgage before lenders adjust their offerings to reflect the new higher rate norm. Even if you're currently locked into a decent rate, think long-term. Will you need a home equity loan in the future? Are you planning to move in a few years and take on a new mortgage? The cost of borrowing will likely remain elevated, so plan ahead. Start building financial buffers now to offset potential increases in monthly payments later. Investors are also in a pivotal moment. Real estate investors who relied on cheap debt to scale portfolios will face tighter margins. But there's a silver lining: fewer competitors. As financing becomes more expensive, many speculative buyers exit the market, leaving more room for strategic investors with sound fundamentals. Look for opportunities in undervalued areas, multifamily units, or alternative financing methods, such as seller financing or rent-to-own models. Being creative and flexible with your approach will be essential in navigating this new mortgage landscape. Let's not forget renters either. With mortgage rates high and ownership becoming more expensive, rental demand will likely surge. If you own rental properties or plan to invest in them, this could be a golden opportunity. High rates reduce home ownership, which increases rental prices and stabilizes cash flow, provided your financing is solid. Now here's a powerful mindset shift. Instead of fearing rate increases, learn how to profit from them. There are financial products and strategies that actually benefit from rising rates. Think about short-term bond ETFs, high-yield savings, and even inflation-protected securities. Understanding the full financial ecosystem helps you not only protect your mortgage, but grow your wealth strategically. We are entering an age where knowledge, preparation, and adaptability will be the new currency. The Fed's decisions are no longer just background noise, they are signals that shape the real economy. So what's your next move? Take the time to revisit your mortgage plan. Speak to a financial advisor who understands the current climate. Use this moment as a wake-up call to refine your goals, your budget, and your vision for the future. And remember, this isn't the end of affordability. It's just a different version of it. You can still thrive in this market, but only if you stay informed, proactive, and ready to shift with the times. If this video gave you real value, subscribe to the channel and activate the notification bell so you don't miss any upcoming updates on housing, finance, and smart money strategies. Together, we'll navigate this changing world with confidence.